Hello fellow intelligent investors, my name is René Salman, and in today's video I want to discuss the single greatest predictor of future stock market returns. And personally I assume that most of you have never heard of this stock market indicator, as it kind of flies under the radar. Well, according to this indicator, and by the way many other indicators, stock market indicators as well, there has never been a time in US history where stocks were more expensive than right now. We've just hit an all-time high, and this might be a warning sign that a major correction is imminent. So without further ado, let's run the intro and take a look at this indicator.
Have you ever wondered how you can make your hard-earned money work for you? Have you ever dreamed of building generational wealth and leaving a legacy? My name is René Salman, and I'll teach you how you can manage and invest your money with confidence, a long-term vision, and without losing your mind. Join me on my journey of intelligent investing and learn how smart people can compound their money effectively and accumulate wealth.
Alright, so if you have watched some of my previous videos, then you should know that I think attempting to time the market can be a dangerous game to play. I simply believe that trying to guess when the market will go up and when it will go down can be a very costly strategy. As the saying goes, more money has been lost by investors trying to anticipate corrections than has been lost in the corrections themselves. So instead, I think you should just take a longer term view and look for businesses that can grow at above average rates for a sustained period of time, because I believe this is a superior investing strategy. However, I feel like it is important to acknowledge that there is a major difference between active investors, so those who try to find the aforementioned superior businesses that have a long runway for growth, an honest and talented management team, and a business model that allows a certain level of forecastability. And passive investors. A passive investing strategy doesn't require any special knowledge about business models, about industry dynamics, the competence and background of management teams, or valuation models. The nice thing about a passive investing strategy is that it involves little to no research and no analysis of the underlying business of individual companies, and therefore little to no time commitment, as an index can hold hundreds or sometimes thousands of stocks, and thus makes it a very diversified portfolio. Investing in index funds guarantees market returns, and it minimizes the time and energy that you need to spend on researching individual businesses. And so it simply frees up time for other activities which can be great for is great for the majority of people. Passive investors, they buy stocks when they go up, but they also buy them when they go down. And thus they buy overvalued stocks, but also undervalued companies. Companies with a great capital allocation track record, but also companies with poor corporate governance. Personally, I believe that passive investing is a great strategy and that the vast majority of people will be better off by investing passively. However, trying to beat the market can be very lucrative, as you could potentially reach your financial goals more quickly, and I've outlined who should attempt to beat the market in my most recent video on Bruce Greenwald's Yahoo Finance interview. And even if you do decide to invest actively and handpick individual stocks, it might make sense to run a so-called dual strategy, at least in your first few years, and allocate a certain percentage of your portfolio to a small number of actively handpicked high-quality stocks, and a certain percentage of your portfolio to one or two broad market ETFs. However, there is a caveat. There has to be, right? Passive investing also has some weaknesses. While it is true that over the last 100 years, the S&P 500 returned around 10% annually, this is only half the truth. It's not like the market just gives you a constant return of 10% a year. That would be too easy, right? No, there are periods of boom and bust. And if we just take a look at the returns of the S&P 500 over the last 20 years, including dividends, I should point out, then we can see that there are some years during which the market dropped as much as 36%. But there are also periods during which the value of a broad basket of stocks appreciated by as much as 32%. And then there are periods during which the market is just flat. The following chart is taken from a presentation Monish Paprai gave at Trinity College Dublin, and it shows the Dow Jones performance between 1896 and 1996. And this chart illustrates that in the US equity market, there have been prolonged multi-year periods of flat returns. There are simply periods where markets do absolutely nothing. But as we have just shown, then there are equally long periods that provide spectacular annual returns, well above the average 10% per year. And Paprai actually also included a similar chart for the S&P 500. So, even if you are or were a long-term oriented investor, if you started at the wrong time, your returns would not be as great as the historical performance of the S&P 500, which is again 10% annually. So what passive investors should ask themselves is whether there is a way to determine whether the current starting point is one of these points, or one of these starting points that will lead to flat returns for many years, or whether it could be a starting point that is followed by a spectacular performance. And obviously, valuation plays a role here. Well, spoiler alert, there is no such thing that can forecast what exactly is going to happen in a year or two from now. However, there are so-called stock market indicators that allow you to quite accurately predict long-term returns of stocks. But here we're speaking of 10 to 20 years. You can think of them as market valuation methods, as opposed to valuation methods to value individual stocks. These stock market indicators allow you to go back in time and look at what has happened from specific valuation levels in the past, and based on these data points, they attempt to draw conclusions for the future and future returns. So generally speaking, stock market indicators allow you to somewhat accurately forecast long-term stock market developments. And just to be clear here, as I just said, we are talking about timescales of 10 to 20 years. There certainly is a relationship between current stock market valuations and subsequent long-term broad market index returns. And these potential returns can be made visible through these indicators. In fact, there are several very well-known stock market indicators that you might actually already have heard of. For example, you might be familiar with the regular PE ratio for a broad market index. Or maybe you have heard of the CAPE ratio, also known as the Shiller PE ratio, which is essentially a price to earnings ratio for the entire market, but that is adjusted for business cyclicality. And then finally, another well-known stock market predictor is the market cap to GDP ratio, which is also known as the Buffett Indicator. And then there is actually another indicator that is not as well known as the aforementioned ones. Very few people know it, but quite astonishingly, it can be argued that this stock market indicator is superior to the ones I just mentioned, and it outperforms the other predictors when it comes to predicting long-term stock market returns. It is known as the average investor allocation to equities, or in short, AIAE, and it was developed by an anonymous blogger who's still unknown today, but who can be found under the handle Jesse Livermore on Twitter. In fact, in my video on Bitcoin, I've included a few clips taken from a podcast episode with Jesse Livermore. And if you haven't watched that video, you might want to check it out, as Livermore is an incredibly eloquent and smart guy. Anyway, Livermore published the AIAE indicator on his blog that is called Philosophical Economics in 2013. The indicator itself is not complicated, but rather simple in nature, and looks at the average asset allocation of US households, so allocation to stocks, bonds, and cash. And the indicator simply shows what proportion of US citizens' savings is currently invested in equities, so in stocks. Basically, this indicator consists of only a simple ratio between two numbers. First, the total amount of stocks that investors in aggregate are holding, and secondly, the total market value of financial assets that, again, investors in aggregate possess. The interesting finding of Livermore is that the higher the share of equities, the worse the performance of the stock market in the following 10 years. So the higher the proportion of stocks, the closer we are to a market top. And this can be visualized in a chart. The red line here shows what percentage of Americans' net worth is allocated to stocks. And the blue line shows the subsequent S&P 500 10-year annualized returns. And the explanation for this correlation is rather simple. The more a stock market goes up, the more people like to invest in it or to invest in stocks because they are reassured by the past performance of equities. If, on the other hand, stocks have done quite poorly in the recent past, or there has been a major crash, more people will pull out money of the market and invest their money in other assets. Investors' sentiment, at least in the short term, moves stock prices. And if you look at the projected future 10-year returns, you can see that Buffett's formula to becoming wealthy: buy when everyone else is fearful and sell when everyone else is greedy, describes the result of this crowd behavior. When the allocation to stocks is the lowest, the expected future returns were the highest. This is one explanation for the correlation between the two lines. But in my view, there is another explanation. It's helpful to understand the distinction between leading and lagging indicators. Leading indicators attempt to predict where prices are headed, while lagging indicators offer a historical report of background conditions that resulted in the current price being where it is. I would argue that the AIAE is a leading indicator, as it can quite accurately predict future long-term returns. But it is also a lagging indicator of a downturn, as it is also affected by past performance. If, for example, the market drops 50%, it only makes sense that stocks as a percentage of assets goes down too. For example, let's say Frankie has a net worth of $200,000, of which $100,000 are invested in stocks, and the stock's value goes down by 50%. He now only has 33% of his assets in stocks. And similarly, if stock prices go up very quickly and appreciate more than the actual underlying value of the businesses, the percentage of Frankie's net worth tied to stocks will go up too. Say stocks go up 50% in a short period of time. All of a sudden, Frankie's stock investments represent 60% of his net worth. As a predictor of future stock market returns, the AIAE indicator outperforms all other stock market valuation metrics that are commonly cited. An ideal time to buy shares was around 2009, when shares accounted for only about 25% of savings of US Americans. Because of the financial crisis, nobody wanted to invest in stocks, and valuations were low. The situation was quite different in 2000, when the average investor allocated almost 50% to stocks. And so, subsequent 10-year returns were very poor, to say the least. Now you can obviously access the chart that I just showed you online, and the website actually updates itself. And I will of course add a link to the website to the description box down below. Well, according to this graph, we are almost at an all-time high, and future long-term returns delivered by the S&P 500 are very likely to be disappointing. Around 1% according to this indicator. Interestingly, according to NDR research data, which is a global provider of independent investment research insights, tools and solutions, the indicator has actually already peaked, as this chart here shows. The chart was shared on Twitter by Twitter user MapFavo, and Jesse Livermore himself pointed out in the comments that, quote, "By most measures, there has never been a time in US history where equities were more expensive than at this moment. The historical mean allocation to stocks is 28%. We're now close to 46%. And it seems like American citizens are all in on stocks. And what followed when stocks as a percentage of household assets exceeded a certain level were usually remarkably poor returns. So I think this indicator should definitely be a warning sign for passive investors. Now, maybe just on a side note, I wanted to point out that allocation to stocks in other countries is much lower, probably due to cultural reasons. In the United Kingdom, for instance, as of 2020, shares in equities amounted to 10% of total household assets. In Germany, the average investor's portfolio has a 17.5% allocation to equities. Now, what's important to mention here is that just because we're at a record high, this doesn't mean that a crash is imminent, that a crash is around the corner. All of the stock market indicators have been flashing warning signs for a couple of years now. And Jesse Livermore himself already pointed out in 2013, when he presented this indicator, that there is a plausible reason for the stock allocation percentages to be so high and the subsequent below average stock returns. In his essay, he wrote the following: "The more important question, however, is this. Why should the stock market offer investors the average historical return right now? If over the next 10 years, bonds are offering investors 2.8% and cash is offering them less than 1%, why should stocks be priced to offer them 8 to 10%? How would that even be sustainable? If equities were offering an 8 to 10% return, we would all choose to allocate the bulk of our portfolios into them, rather than languish in the SERP nothingness of bonds and cash. There obviously isn't enough equity supply for all of us to allocate in that way, and so the price would get pushed up and the expected return pulled down very quickly." So what's the bottom line here? Well, Jesse Livermore's stock market indicator is rarely mentioned, but it is claimed to have the best accuracy when it comes to predicting long-term stock returns. Americans are now holding a higher percentage of their net worth in stocks than ever before, as stocks now represent almost 46% of US households' financial assets. Prior peaks in this indicator have preceded quite severe bear markets, and thus investors should be aware of the elevated levels we are currently at and what this means for their future long-term returns. Sure, we just hit another record high, but as an intelligent investor, you need to acknowledge that the stock market indicators I just mentioned in this video, they are no crystal balls. You cannot use these indicators to predict what is going to happen in a month, a year, or 2 years from now. Warren Buffett already once said, "I have never met a man who could forecast the market." And I think Buffett is talking about the short term here. So you cannot pinpoint the next market crash with the help of these indicators. No, instead they are just a look at history and allow you to get an idea of what kind of long-term returns you can expect based on current valuations. And again, long-term does not mean 1 to 2 years. No, we're speaking of 10 years or ideally even longer time periods. As of June 20th, the AIAE indicator is forecasting 1.37% annualized over the next 10 years for US equities. The 10-year US Treasury yield is at 1.44%, and thus, in finance speech, the expected equity risk premium is minus 8 basis points. And what is noteworthy is that the expected equity risk premium was negative for over 4 years during the run-up to the dot-com market top and for 2 months during the run-up to the 07 peak. Now, I do believe that most people should invest passively. And I even believe that many part-time investors who do decide to pick stocks actively should at least consider running a dual strategy. But personally, I don't feel confident putting any money into the S&P 500 index, as I'm not content with the expected returns, and I hope to do better by doing my due diligence and picking individual stocks that I expect to deliver better returns. And just not to spread fear in this video, let me stress one more time that just because the indicator is at an all-time high, a crash is not necessarily around the corner. The indicator has been well above its mean for more than 10 years now. And even when it comes to the predictability of future returns, Jesse Livermore, so again the author or developer of this indicator, has cautioned investors not to place too much emphasis on stock market indicators. In a follow-up essay titled Valuation and Stock Market Returns, Adventures in Curve Fitting, Livermore wrote, "Looking backwards and fitting valuation metrics to precise returns, so as to come up with a precise estimate, is not a productive exercise. Unless the ensuing value versus return charts are rigorously and extensively tested out of sample, without the chart maker already knowing the answer and being able to spend time tweaking out a visually pleasing hindsight fit that takes advantage of happenstance, coincidences in market history. Their predictions should be ignored or at least taken very lightly as an extremely general comment about the future. Maybe the comment here is future returns will be lower than history. Fine, but don't try to go any farther and distinguish between low as 5% and low as 2%. Okay, and with that I want to wrap it up here. As always, may your finances and investments prosper. Good luck.